What's up, e-commerce entrepreneurs? This is Chris Rivera, founder of the E-commerce Accountants. I hope everybody is doing well. Today, I am excited to introduce our latest topic, and that is tax planning for foreign e-commerce entrepreneurs. This is definitely a topic that's been in high demand pretty much ever since we've started as an accounting firm in the e-commerce space. So we are definitely excited to share some of the details and insights that we see are most effective with foreign e-commerce entrepreneurs. Now, before we get started, I want to emphasize that the topics covered in this video are highly complicated. So complicated that we're actually breaking this up into a 2-video series. Now, I don't want that to scare anyone off because we are going to water down these highly complicated concepts and simplify them so pretty much any e-commerce entrepreneur can fully understand the content in the video. However, we do want to make sure that you watch both videos in their entirety to make sure you have a full understanding of how these principles are applied and how they work for you if you are indeed a foreign e-commerce entrepreneur. Before we jump too far into the weeds, I also want to remind you that if you find this content valuable, please like this video, subscribe to our channel. Those are both indicators that the content that we're putting together is valuable to you as an e-commerce entrepreneur as well as the rest of the e-commerce community. So we want to make sure that we're putting out relevant content that you are enjoying. Before we dive into the tax structures that make sense, we first need to separate foreign e-commerce entrepreneurs into 2 separate categories. This is all centered around effectively connected income, or commonly referred to as ECI in the accounting community. Effectively connected income essentially means that you do have to pay income taxes in the US, and if you don't have effectively connected income, that generally speaking means that you do not have to pay income taxes in the US. First, you have to understand whether or not you have effectively connected income. We broke this out into 2 separate tests that you can use as a foreign e-commerce entrepreneur to identify whether or not you have effectively connected income. The first test is, do you have inventory in the US? If you are an Amazon seller and your inventory is sitting with Amazon FBA, or if you have a warehouse in the US that has inventory, that would be considered physical presence in the US, and therefore we would consider you as having effectively connected income. The second test is you as an entrepreneur, what is your physical presence? If you are a US citizen, we automatically consider you as having effectively connected income. So this video is truly intended for foreign non-American entrepreneurs. But also, if you are a non-citizen that's living in the US for 31 days or more, that would also be considered effectively connected income. So to simplify this further, if you have inventory in the US, or if you live in the US for 31 days or more, or you're a US citizen, you have effectively connected income. Otherwise, if none of those things apply to you, you do not have effectively connected income. So the first video here is going to be tax planning and tax structures that work for e-commerce entrepreneurs that do have effectively connected income. And before we get too far ahead of ourselves, I'm gonna put a link in the description below to the IRS website, which clearly defines what effectively connected income is. But my recommendation would be for you to take our word for it. We've done tax planning for many foreign e-commerce entrepreneurs. And to be honest with you, if you take the time to read through the IRS description, you'll see that it's highly complicated. So if I were you, if you're an e-commerce entrepreneur that does not specialize in tax, just keep it simple and focus on our definition of effectively connected income and look forward from there. Now that you have a good understanding of effectively connected income, let's jump into my laptop and cover, if you do have effectively connected income, what is an ideal tax planning strategy for you? Okay, so welcome into my computer. The first strategy we're going to cover here is, again, if you have effectively connected income, we recommend the C Corp, Block or Corp with what's called transfer pricing. This is what transfer pricing is, basically a management services agreement here. Let's get started here. Let's say we have an entrepreneur. This entrepreneur lives in Ireland. He is not a US citizen. And let's say that he has inventory sitting in the US. Typically what we recommend is that they set up a structure similar to this. Now, how this would look before any restructuring is essentially this entrepreneur would just own 100% of a foreign entity, which is Not what we recommend, because as many of you e-commerce entrepreneurs know, if this entity owns a Shopify store directly, or really any direct-to-consumer website, then the foreign transaction fees will be outrageous, and that wouldn't be very wise from a business standpoint, let alone a tax planning standpoint. So if you check out the structure here, we have this foreign entrepreneur is not a U.S. citizen and does have inventory in the U.S. They own 100% of two separate entities. One would be an entity in their foreign country, in this example is in Ireland, and one would be a U.S. corporation, not an LLC, a U.S. corporation, or an LLC with a C corp tax election. It has to be taxed as a U.S. corporation. That's immensely important for this structure to work. So this entrepreneur will own 100% of both entities. Now, the purpose of the U.S. entity is to do all of the operations of the business, meaning this is the company that operates the entire U.S. brand. It has a customer which does e-com, or has customers that do e-com purchases, and the products get shipped to the customers. And basically, this company is in the business of e-commerce. It owns the inventory, it runs the ads, it has its own bank accounts and credit cards. It handles all of the operations for the e-commerce part of the business. Separately, you have an Irish company, and this is a management company. This is basically intended to get money out of the US in as tax-friendly way as possible. What we're trying to do is limit your exposure to taxes in the US to basically as little or as much as you want. Again, that's limited by transfer pricing rules, obviously, but this is intended to split up your tax risk. So essentially what's happening is this company generates income, but the way you get it out of the US is basically there's another company overseas that gets compensated for management services. This company provides management services and in turn gets compensated a fee. Now this fee could be a fixed fee. This fee could be a percentage of profits. We've seen a lot of different things in this space, but typically what we recommend is you put together a contract that makes the most sense for you. And what happens is the management fees that get paid out to the foreign management company are deductions here in the US, and they're actually income to the foreign country. Now, this works really, really great in instances, for example, like Dubai. They just changed their rules to where they're gonna have a corporate tax rate going forward. But if you have a country that has a 0% tax rate, any management fees that are paid out to this foreign country are taxed at that rate, and they're deductible at this rate. Let's take a look at some numbers here. Let's say you have a US Corp, is color coordinated here, and Ireland Corp is color coordinated here. The idea is if you do $1 million in sales, you have cost of goods sold, you have advertising, merchant fee, software, etc. Your net profit is around 24% or $240,000. Let's say these companies have an agreement that 50% of the profits is paid to that foreign company. So the management fee would be $120,000. So the taxable profit in the US would be $120,000. So in the US, in this example, you would pay $25,200. Now, the Ireland side, the only income that exists is the money that comes in from the management fees. Now, you might have other expenses. Maybe in Ireland, you have to pay yourself a salary, or maybe you have to hire an assistant or something like that. But at the end of the day, the vast majority of the operations for this Ireland Corp will be related to management services. So there probably won't be a ton of expenses here. And basically here in Ireland, when we researched it, there's a 12.5% tax rate for corporations in Ireland. So in total, you're looking at around $40,200 in taxes, which is essentially a 16.75% effective tax rate. This fact pattern changes tremendously if, like I said before, you have a corporation based out of Dubai or another country that has a 0% tax rate. Let's just say it's in Dubai and it's the year 2022. You would have this same agreement in place where $120,000 is deducted in the US, so you pay less US income taxes. But let's say in Dubai you have $120,000 in income, that tax rate would actually be 0. So the effective tax rate would actually come way down in that scenario. So this is definitely a very cool way to structure your business operations if you are a foreign entrepreneur that does indeed have effectively connected income. This is very effective way to operate for foreign entrepreneurs. The key takeaways here as we close out this video. Number one, transfer pricing contract is a must. It's extremely important. This relationship here, this management services arrangement has to be documented. There has to be a contract that's put in place, and you have to follow that contract. So if you say that 50% of profits are to be paid to this management company, 50% of profits do have to be paid to the management company, and you have to make sure that you actually make the payments. These two companies have to operate completely separately. They're not related companies. They're two separate organizations. So we want to make sure that everything is fair to keep this tax planning structure safe. The second thing is you will need to obviously follow US tax return. This company will pay US income taxes, so you want to make sure that you stay compliant from a US income tax standpoint. And the last thing we have here is that the US entity will need its own bank accounts and credit cards. It's immensely important. That means this company cannot have the same bank and credit cards as this company, or neither of these companies can have the same banks or credit cards as you as an individual. So you want to make sure that you keep all of the accounts separately. You pay your own rent in your own personal account. This company should be paying its own expenses. It should pay its own credit cards with its own bank account. This company should pay its own credit cards with its own bank account, etc. Okay, so that concludes all of the learning here from video 1. If everything makes sense to you, you can proceed on to video 2. Again, as a reminder, if you could like this video, smash that subscribe button. That helps us out tremendously. Without further ado, I will see you on the other side here on video 2. Thanks, guys.